Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we are diving deep, and I mean really deep, into two massive shifts that are, well, they're basically challenging the fundamental laws of finance and economics as we know them.
Yeah.
If you've been watching the markets lately, you know that the old rulebook feels increasingly useless. So our mission here is to give you the updated cheat sheet. We're tackling two, let's call them seismic events. They might seem unconnected at first, but they're both radically redefining risk and reward. The first one is a huge economic shock. The long-held idea that tariffs automatically lead to higher prices, inflation, that's being aggressively challenged by some new, really deep historical analysis from inside the Federal Reserve System. And the data suggests something pretty surprising. It suggests tariffs might actually be deflationary.
And the second shift is, well, it's more of a structural revolution. It's about who holds the keys to the kingdom now. We're sort of moving past this era where the market was all about hedge funds and these big centralized institutions. The new driver, the big unpredictable force, is what we're calling the evolved retail investor. And their power is just magnified, almost exponentially, by these sophisticated, super high-speed tools like 0 days to expiration options.
Right. And these aren't just, abstract theories for a classroom.
Oh, not at all. I mean, understanding these two paradigm shifts is absolutely essential because they are the basis for pretty much every major decision the Federal Reserve is making right now.
And every trade the big institutional players are placing.
Exactly. They directly drive interest rate expectations, they completely redefine what portfolio risk even looks like, and they just fundamentally break all the traditional ways we value companies. We really have to tackle these paradoxes and these new power dynamics head on.
Absolutely. So here's the plan. We'll first unpack what we're calling the tariff paradox, and we'll dissect these stunning findings from a recent SF Federal Reserve report. Then we will get into the new rules of the game that are being dictated by this retail army. We'll explore how their weapon of choice, the 0DTE option, creates these powerful, almost self-fulfilling market moves. So let's start with the economic consensus that just got, well, basically tossed out the window. For the last several years, especially during the trade wars under the Trump administration, the second you heard a policymaker mention the word tariffs,
Yep.
the immediate overwhelming market fear was one thing. Stagflation. That was the unchallenged consensus, and it kept the Fed up at night.
It did. And that traditional logic was completely based on the immediate effects of what we call a supply shock. So if the government suddenly slaps say a 25% tax on steel or microchips or, finished goods coming in from overseas,
Correct.
well, the manufacturers here that use those parts suddenly face a 25% higher cost for their basic ingredients.
And the businesses aren't just going to absorb that cost, right?
Yeah.
They're not going to just eat it.
Precisely. They pass those costs downstream to the next buyer, whether that's another business or eventually you, the consumer. So this increase in costs, it just ripples through the whole economy, and the result is broad price increases. That's the deflation part of stagflation.
The inflation.
The inflation.
Yeah.
And at the same time, because trade is all messed up and prices are higher, economic activity just slows down. People buy less stuff.
And that's the stag part, the stagnation.
Exactly. That simultaneous hit of high inflation and low or even negative growth stagnation, that's the monster we call stagflation. It's a policy nightmare because the tools you use to fight one problem, like raising interest rates for inflation, make the other problem, the stagnation, even worse.
We can use a pretty simple analogy here, right? Imagine you run a big restaurant. And you import a lot of your key ingredients, say special olive oil from Italy, cheese from France. Suddenly, there's a new 15% tariff on those imports. Your cost to make a plate of pasta just went up.
Right.
So you have to raise your menu prices. That's the inflation. But because your food is now more expensive, fewer people come to eat at your restaurant. You have to cut staff hours. That's the stagnation.
And that was the consensus, that tariffs were just inflation delivered right through the supply chain. And that thinking has, it's dominated policy for decades.
But not anymore.
Not anymore, because the SF Federal Reserve went back and they analyzed 150 years of really robust historical data covering all these huge shifts in trade policy. And what they found was that this supply shock model, it's incomplete.
And it misses the main point.
Crucially, it misunderstands the dominant effect of tariffs.
And this is where we hit that paradox. The SF Fed's finding is it's stunning. They're saying tariffs don't primarily cause inflation. They cause deflation by starting a total collapse in aggregate demand. Okay, that feels really counterintuitive. I mean, how can prices fall if the cost of the ingredients went up? If my restaurant is paying more for olive oil, shouldn't my menu prices have to go up?
They absolutely would in a vacuum. But that supply-side cost increase is just. It's dwarfed by this psychological and behavioral response that the tariff policy itself kicks off. The mechanism here is less about the immediate cost of olive oil and almost overwhelmingly about the massive dose of extreme uncertainty that gets injected into the system. Think about it. The moment a major trade war starts or a new round of tariffs is announced, the whole economic landscape just becomes totally unpredictable.
Right.
If you're a CEO, you suddenly have no idea what your future costs will be. You don't know who your suppliers will be in 6 months. You don't know if the policy will just be reversed overnight.
So it's paralysis.
Total paralysis.
Yeah.
And that forces huge changes in behavior, especially when it comes to big, long-term investments, what we call capital expenditure or CapEx.
So instead of focusing on the rising price of, say, lithium for batteries, we need to focus on the rising fear of the future.
Exactly. When you're faced with that kind of extreme uncertainty, what does a corporation do? They immediately halt any big, long-term, non-essential investment. I mean, why would a company break ground on a new $500 million factory or hire hundreds of specialized workers if the entire cost structure of that factory could be blown up by the next tweet or policy announcement?
They wouldn't. They'd freeze hiring, postpone the factory, and just wait and see.
They wait. And that corporate paralysis is step one. Step two involves the consumer. Us. We read the headlines about trade wars and corporate uncertainty, and we start to get really nervous about our own job security, the stability of our 401k. And this doesn't just mean we cut back on, buying coffee. It specifically hits the big ticket items, the non-essential high-value spending.
So that's the difference between maybe buying a slightly more expensive imported T-shirt and deciding not to finance a brand new SUV.
Precisely. It's the collective decision by millions of people to just postpone buying those major assets, houses, cars, fancy electronics, big home renovations, and that leads to a massive systemic total demand collapse.
And all of a sudden, the car lots are full, but the buyers are all gone.
The buyers have vanished. And when demand disappears, what's the only thing a seller can do to move inventory and stay in business?
Drop prices.
They have to drop prices. And that force, driven by this huge psychological shock of uncertainty, is so powerful that it completely overwhelms the little bit of cost-push inflation from the tariffs themselves. So the end result is actually a recessionary environment characterized by price drops. Deflation.
It's fascinating. And the SF Fed used all that long-term historical data to prove this point. What did their numbers actually show? What was the magnitude of this effect?
Yeah, the quantitative finding in the study was basically a punch in the face to the old consensus. They proved that a permanent 4 percentage point increase in tariffs, which is a pretty big move, historically resulted in lower inflation, higher unemployment, and declining economic output.
Wow.
And that trifecta, lower inflation, higher unemployment, falling output, that is the classic textbook definition of a recessionary downturn with deflationary pressure, not the stagflationary spiral everyone was so afraid of.
So, to bring it back to that personal analogy, you feel uncertain about the economy because of all the trade war talk. That uncertainty makes you delay buying that $50,000 car. When the dealership sees its lot filling up with unsold cars, they're forced to start offering huge discounts just to make a sale. So the deflationary pressure is forced by the buyer's fear, not the seller's low costs.
And that collective fear, that collective reluctance, captured across a century and a half of trade data, that is the dominant economic force. So tariffs are not primarily a supply problem, they're a demand problem. And it's rooted in the paralysis caused by high policy risk.
Now, academic reports come out all the time, but this one didn't stay academic for very long, did it?
No, it did not.
The reason it became an instant market mover, a real-world catalyst, was the involvement of one person, Nick Timiraos.
Yep.
And for listeners who might not follow financial journalism this closely, Timiraos is, he's often called the unofficial spokesperson for the Fed. He just has this remarkably accurate insight into the thinking of the Fed's leadership.
His amplification of this report was everything. I mean, when Nick Timiraos dedicates a big chunk of analysis to highlighting the SF Fed's counterintuitive findings, the market reads that as one thing.
A signal.
It's a huge signal that the old entrenched tariff equals inflation idea is now being seriously questioned inside the Fed's inner circle. It meant top policymakers were actively looking for a reason to break with that old consensus.
And the market reaction was what, immediate.
Yeah.
It played out dramatically on that Monday, November 17th.
Oh, instantaneous. The financial world runs on expectations, right? And once that expectation of tariff-driven inflation was weakened, the whole market had to recalibrate. First thing we saw was a massive move in the Fed Watch tool. Expectations for a December rate cut just surged back above 70%.
And before this report, the market was nervous, right? Leaning towards the Fed just holding rates steady.
Leaning toward a freeze, yeah, because of those lingering inflation fears. But if the Fed now thinks tariffs actually cause recession and deflation?
Then the biggest reason not to cut rates is just gone. I mean, cutting rates to fight deflation is Fed 101.
It's standard operating procedure, exactly. And this shift in policy expectation triggered the second reaction, which was this huge synchronized rally in both bonds and stocks. The easing of the tariff-driven inflation story let U.S. Treasury yields drop, which means bond prices soared.
And lower yields mean cheaper money, which is basically rocket fuel for growth and tech stocks.
Rocket fuel. So consequently, NASDAQ futures, which are full of those rate-sensitive growth stocks, they just rallied hard. And the entire move was kicked off by this idea that the Fed had found a new structural reason to be more dovish.
Okay, so we've established the paradox and the immediate market move. Let's translate this for the listener. What are the, say, 4 big strategic takeaways from this new deflationary framework?
All right, the first insight is actually pretty positive for overall market stability, and it's that the stagflation ghost is weaker. That scenario that causes the most fear, a simultaneous recession and runaway inflation, it's just structurally less likely if tariffs actually cause deflationary pressure.
Right. Deflation is a huge problem, but it's a problem the Fed knows how to fight with its usual tools.
Exactly. It's a standard economic downturn that the Fed can treat with monetary easing, with rate cuts. So this is fundamentally good news for both stocks and bonds because it kind of removes the threat of the worst possible policy nightmare.
The market hates uncertainty and policy dead ends. So getting rid of the stagflation boogeyman is a huge structural relief.
Okay, what's the second, more tactical insight about the Fed?
The second insight confirms a stronger case for Fed easing, and it's really important to connect this tariff idea with other recent economic data. As you know, the source material we looked at also highlighted some recent softness in the labor market. People were calling it the employment shock. Yeah, we should probably define that employment shock for a second, because it's really important context here.
Absolutely. The employment shock just refers to some specific, unexpected weaknesses we've seen in the job numbers. Things like a sharp, sustained rise in the weekly unemployment claims.
Right.
And also a noticeable drop in the JOLTS report, that's the job opening survey, which was signaling that job openings were falling way faster than anyone expected. That data was already making people worried about a recession.
So you put those two things together.
You pair the very real concerns about a cooling labor market with this new SF Fed report, which basically removes the inflation fear tied to tariffs. And suddenly, the path for the Fed to cut rates, maybe even aggressively, is crystal clear.
Some were even talking about a dramatic 127 rate cut.
They were. And this makes bonds and growth stocks look really attractive, at least in the short term.
Which leads us perfectly into the third and kind of depressing insight about how the market thinks now. The return of bad news is good news.
Ugh, yes. This is a cynical framework, but it's an absolutely necessary one for investors to understand right now. Because the market is so obsessed with liquidity, with cheap money from the Fed, news isn't interpreted based on what it means for the health of the economy anymore. It's interpreted purely on how it might force the Fed to act.
So the new rule is what?
The new rule is this. If the administration announces new tariffs or escalates a trade war, which is objectively bad news for global trade and corporate profit,
Traders will cheer.
traders will celebrate. They see the tariff hikes, the bad news, as something that will force the Fed's hand to cut rates sooner to fight that demand collapse. And that's the good news.
It's a liquidity addiction.
It is. It revives this infamous dynamic where bad policy and weak economic data are cheered because they translate directly into cheap money.
So we've got all this short-term optimism, but you mentioned there's a crucial long-term danger that remains.
Yes, this is so important. While the short-term market is all about rate cuts, the real long-term threat is uncertainty itself. See, the Fed's rate cuts can boost the price of assets by making money cheaper, but they can't fix crippled earnings growth that's caused by business paralysis.
That's a great point.
Tariff-induced uncertainty, as the SF Fed proved, it just crushes business investment and consumer confidence over the mid to long term. If CEOs stop building factories, if they stop hiring, that paralysis slows the real economy to a crawl. And eventually, corporate earnings, which are the fundamental driver of long-term stock value, they will reflect that deep economic damage, no matter how much cheap money the Fed is pumping in.
So the smart investor needs to be watching earnings reports way more closely than Fed press conferences.
That's the measure of the real economy's health.
Exactly. Okay, that was a powerful restructuring of our economic assumptions. Now we need to shift to the structural side of the market. And this might be even more critical for how things move day to day. The rise of the evolved retail investor. The entire center of gravity in finance has shifted. And the traditional gatekeepers, the big institutions, they are terrified.
They absolutely should be. I mean, the data we've seen confirms a seismic change in who controls the market. The center of gravity has moved from a very concentrated few, the hedge funds, the big trading desks, which now only account for about 2% of market volume.
2%, that's it.
That's it. It's moved to passive index funds and, crucially, to individual households. And together, passive funds and households now command a staggering 53% of the market's volume and ownership.
53%. That's undeniable dominance. So the individual investor is no longer just a participant following the big money. They are the flow. They are the driver of where the market goes.
And this driving behavior is perfectly captured in the absolute explosion of something called 0 days to expiration, or 0 DTE options. This instrument is the signature weapon of the evolved retail investor.
Okay, let's make sure we define 0 DTE options really clearly because they are a sophisticated high-speed concept.
Right. So an option gives you the right, but not the obligation, to buy or sell something like the S&P 500 index at a set price by a certain expiration date. A 0 DTE option is an option that expires on the very same day you buy it.
The same day.
It is pure aggressive speculation. It's highly leveraged and incredibly cheap to buy up front, so it offers these massive potential returns or massive potential losses based on tiny little market movements within a single day.
And the volume here is just off the charts.
It's terrifyingly large. The data shows that by October of 2025, 0 DTE options exceeded 50% of the entire S&P 500 options trading volume.
More than half.
More than half of all the short-term directional bets on the entire U.S. market are now happening in this ultra-fast, high-leverage space, and it's dominated by retail traders who are often coordinating through social media.
So what makes this volume so important? Why does a bunch of retail traders gambling on a derivative translate to them being the driver of the actual index? Why aren't they just speculating on the side?
This is the crucial technical point we need to unpack. It's something called the gamma effect, which has to do with how the market makers hedge. When a retail investor buys one of these highly leveraged 0 DTE options, the big Wall Street institution that sold it to them, the market maker, has to hedge its risk. They don't want to bet against their own client.
And be neutral.
You want to stay neutral. So if a retail investor buys a call option, which is a bet the market will go up, the market maker, to hedge themselves, has to go out and buy the underlying index futures or shares.
Okay.
But here's the kicker. If the market starts moving up in the direction of the retail bet, the market maker's initial hedge is no longer enough. They become short gamma, which forces them to buy more of the underlying assets to get back to neutral.
I see. So a small coordinated bet by retail traders gets amplified because the market makers are forced to buy along with them, creating this powerful feedback loop.
Exactly. And that dynamic is what turns a retail trade from just a speculative bet into a self-fulfilling prophecy. It's a positive feedback loop we call a gamma squeeze. Small retail demand for the market to go up forces market makers to buy stock, which pushes the price up, which then forces market makers to buy even more stock, which just accelerates the rally.
And I assume it works on the way down, too.
It works just as powerfully on the way down. If retail is betting down, the forced selling by market makers can accelerate a crash. So this massive volume, driven by the instant sentiment of individual investors, proves that the market's direction is now based on this ultra-short-term supply-demand imbalance and pure emotional momentum. It's completely unmoored from the long-term fundamentals of, corporate health.
This structure just fundamentally breaks the entire 20th century idea of finance, where a company's value was tied to things you could actually measure, like assets and debt and future cash flow.
That world is collapsing. We're literally witnessing the breakdown of classic valuation metrics. I mean, analysts still calculate price to earnings, PE ratios, or price to book, but in a lot of these high momentum sectors, those metrics have lost almost all of their predictive power over short and even midterm price moves.
So what's the new formula?
The new valuation formula is cynical, but it's true. A stock's price is now determined by story and hype, not earnings. It's all about the narrative, the future potential, and this collective enthusiasm that gets amplified by social media and zero DTE volatility.
And the prime example of this was that huge AI rally we saw in 2025. I mean, that looked less like traditional investing and more like just collective betting on a tech story.
The AI bubble is the definitive case study. You had companies with hardly any profits or even with questionable business models trading at PE ratios that would have been an absolute joke 5 years ago, PE of 100, 200 or more.
Yet the stocks just kept going up.
They surged relentlessly, and the momentum wasn't driven by any detailed earnings reports. It was driven purely by the association with the new logo, artificial intelligence, and the powerful, unified energy of individual investors who were buying the dream and completely ignoring the balance sheets.
And this collective power, it's not just for high-flying tech stocks. It can be aimed at anything, as we saw with that weird surge in low-quality stocks earlier in November.
Oh yeah, that was a perfect echo of the 2021 GameStop phenomenon. These were stocks that institutions had heavily shorted because their financials were genuinely terrible. They were low-quality, struggling companies.
But that didn't matter.
Didn't matter at all. Concentrated retail buying, maybe partially coordinated, generated these sudden, powerful, short-term price explosions. And that demonstrates, beyond any doubt, that retail coordination can just instantly override professional, fundamental analysis.
So if you're a hedge fund manager, a professional who's been trained for decades to spot fundamental value, how do you even manage risk when the market can suddenly be hijacked by this collective, unpredictable, and highly leveraged retail force?
You don't. You're forced to basically declare institutional surrender. They've realized they cannot win this fight. Their entire survival strategy has had to be rewritten.
And the first thing to go was shorting stocks.
The first major casualty was the direct individual shorting of stocks. Institutions are absolutely terrified of taking a short position. Betting a stock will go down on any specific company that might become a target of this meme power.
The risk is just too high.
It's insane. When you short a stock, your theoretical loss is infinite if that stock goes vertical.
Right, it can go up forever.
And if that stock is suddenly targeted by the retail crowd, you face the nightmare scenario of the short squeeze, where you are forced to buy back shares at skyrocketing prices just to cover your losing bet. That one event can wipe out an entire fund.
And the fear of that has just driven them out of the game.
The fear of that one unforeseen, meme-driven short squeeze has effectively chased professional short sellers out of the individual stock market almost entirely.
So they stop fighting the retail army stock by stock.
Yeah.
What's their new survival plan?
Their new plan is a strategic retreat to hedging. So if they believe the AI rally or the overall market is way overvalued because of all this retail hype, they avoid shorting Apple or Nvidia individually.
Too risky.
Way too risky. Instead, they hedge the entire market by buying massive amounts of S&P 500 index futures, or, and this is the most critical part, they buy the VIX index.
The VIX, the fear index.
The fear index, exactly. It's a measure of implied volatility. Basically, how much the market expects prices to swing around over the next 30 days. When institutions buy the VIX, they are buying insurance against a broad market decline.
So the research data we saw describes this as a declaration of surrender. They're essentially betting against the whole ship, but they refuse to get into a sword fight with any of the individual crew members.
That is the perfect summary. By hedging the index, they're avoiding direct conflict with the retail crowd on specific stocks, which are so vulnerable to those gamma squeezes. They're saying, we think the overall valuation is crazy and we are buying portfolio insurance, but we will not take the infinite risk of shorting a name that might become the next GameStop. And that hedging behavior, that gives us, the listener, a huge signal about what they're really worried about.
This changes the entire playbook. I mean, if the rules of the game are now defined by momentum and fear in index flows, then the listener's strategy has to adapt. So let's break down the 4 critical insights for how to navigate this new crazy landscape.
Okay, insight number 1 is about using that institutional fear we just talked about. It's leverage institutional fear, the squeeze. Since institutions are now so scared to short individual stocks, any company that still shows an abnormally high level of institutional short interest becomes a potential high yield but also very high risk opportunity.
So how does a listener actually look for that? How do you monitor it?
You need to look for services, some are free, that track the short float. That's the percentage of a company's available shares that are being held by short sellers. If a stock has a short float over, say, 20 or 30%, that means there is a massive pool of forced buyers just sitting on the sidelines waiting.
And if that stock gets any kind of good news?
If that stock gets a positive catalyst, an unexpected earnings beat, a big contract, or even just a surge of retail interest on social media, those scared institutions have to scramble to cover their short positions. And that triggers the powerful short-term short squeeze.
And we have to add the big warning here, which the source data reiterates. This is highly risky speculative trading. This is not investing.
Absolutely not. It is a speculative tactic. You're trying to exploit the institutional inability to manage that asymmetric risk.
Got it. Okay, insight number 2 tackles the collapse of traditional valuation. If PE ratios are dead, what do we use instead?
The listener just has to accept that the old benchmark, the idea that a PE of 100 is automatically expensive, is obsolete. You have to update your valuation metrics to include the qualitative things that the evolved retail investor actually cares about.
Like what?
Your new model has to include story, hype, future monopoly, and crucially, community power. And this means your analysis has to become multidisciplinary. You still look at the 10K financial statements, but you also have to incorporate social media sentiment analysis.
So you have to be on Reddit next.
You do. How engaged is the user base? Is the company's CEO a powerful, media-savvy person who controls the narrative? Does the product have this fanatical user loyalty that a traditional financial model just can't capture? This community power is what allows a stock to sustain valuations that traditionalists think are impossible.
So if I'm a listener, how do I actually measure something like community power? It sounds a bit fuzzy.
You have to look at specific engagement metrics, things like unique active users, daily downloads of an app, the share of voice across platforms like X and Reddit when people talk about that stock, high user stickiness, which you can see in low churn rates, and passionate online advocacy. That's a really strong signal that the retail investor base is dedicated. They're likely to buy any dips, which helps sustain that high valuation. You're valuing the fan base as much as you're valuing the earnings.
That's a fundamental shift in how we define doing your homework. Okay, what is the third strategic insight, the one about institutional anxiety?
The third is vital for staying safe. It's monitor the VIX and index hedges. As we said, institutions have surrendered the individual stock fight, and they've retreated to hedging the whole index. Their purchases of insurance tell us exactly how terrified they are.
So what's the signal to watch for?
You need to watch for a divergence. If the stock market is still rising aggressively, the Nasdaq is hitting new all-time highs, but at the same time, the VIX, the fear index, is also climbing, or institutional short positions in S&P 500 futures are going up. That is your strong silent warning.
So the market's going up, but the big money is quietly betting on it to fall.
Exactly. The source data says this signal means institutions are buying insurance. They're participating a little bit in the rally, but they're really preparing for a disaster. For the listener, that silent signal is a major prompt to increase your cash holdings, maybe reduce your exposure to those speculative, hype-driven stocks, and maybe even sell a bit of your index funds to protect yourself against a big correction that the smart money is clearly expecting.
That is a great way to put it. Watch where the pros are hiding, not where they're celebrating. Okay, and finally, the fourth insight, which kind of brings us back to stability and all this chaos.
Yes, the fourth insight is the simplest and, honestly, maybe the most powerful, and that is, embrace the passive tide. In this era of maximum volatility, fast-moving retail crowds, and totally broken valuations, trying to outtrade the market is just extremely hazardous.
Right.
But remember that number? Passive funds are 53% of the market. So the gigantic mechanical flow of capital is always going toward the underlying index. Every time a 401k contribution is made, every time a new dollar goes into a broad index ETF, that money reinforces the stability and the long-term upward trend of the index itself.
So trying to be a stock-picking genius is harder than ever.
It's incredibly difficult. So the most powerful, most stable strategy might just be to ride that gigantic automated flow, Regular, consistent investing in low-cost index funds like the S&P 500 or the NASDAQ 100 is probably the most dependable path to long-term wealth because you're just betting on the market's mechanical default setting.
Which is overwhelmingly powered by passive retail investment.
Precisely.
We've covered a remarkable amount of ground today. I mean, we navigated two massive shifts that are really changing the DNA of how we think about investing in risk. First, we learned that the policy-driven fear of stagflation might be fundamentally wrong.
Right.
The SF Fed is suggesting that tariffs, historically, cause deflation by collapsing demand through extreme uncertainty. And that has immediately opened the door wide for potential, maybe even imminent, Fed rate cuts, which eases a lot of liquidity fears.
And second, we explored this new structural reality where individual momentum, supercharged by zero DTE options, has just completely dethroned traditional valuation and forced the big institutions into a strategy of fearful, generalized index hedging.
And this creates a really deep tension that every investor has to navigate now, because in the short term, both of these factors are actually creating a powerful relief rally.
They are.
You have the expectation of cheaper money coming from the Fed, and that's combining with this relentless momentum and hype that's being generated by the evolved retail investor.
But that's the tension, right? This short-term sugar rush is masking a really profound long-term decay. While liquidity is high and spirits are high, investors have to recognize the persistent threat of economic paralysis from that tariff-induced uncertainty, which will eventually drag down corporate earnings.
So you're getting a simultaneous boost from the central bank and structural damage to the underlying real economy.
That's the contradiction we're living in.
So what's the final actionable thought you want to leave with our listeners today? How should they approach this inherently contradictory and volatile market?
I think. Despite all the unprecedented chaos that the evolved retail investor has introduced, the constant volatility, the hyperspeed trading, the broken valuation metrics, the most dependable strategy remains the one that's least involved in all that daily trading noise.
The boring one.
The boring one. The individual who tries to out-trade the zero DTC crowd or out-analyze the speed of institutional hedging is just... They're likely to get wiped out by these gamma effects or sudden reversals. So the best way to win this new game of volatility and hype might be to simply bet on the underlying engine, the broad index, that 53% of the market is already mechanically and faithfully funding every single day.
So patience and diversification are still the answer.
Patience, diversification, and a focus on long-term time horizons. Those remain the ultimate competitive advantages in this hyper-volatile new world.
Fantastic insight. We really appreciate you diving deep into these sources with us today. Don't forget to subscribe and hit that like button.